This is a receipt from APMEX, one of the largest precious metals dealers in America, dated January 29, 2026 at 11:47 a.m. Central Time. The receipt shows an attempted purchase: 10 1-ounce American Gold Eagles, quantity 10, unit price $3,847 each, total $38,470. Below the order details, in red text that I've never seen on an APMEX receipt before, 4 words: item currently unavailable. Waitlist. Waitlist. For American Gold Eagles, the most popular gold coin in the United States, the coin the U.S. Mint produces by the millions, the coin that has been in continuous production since 1986. Unavailable. At the largest dealer in the country. Now open another browser tab. Pull up the COMEX gold futures price. The February contract, actively trading, shows $2,847 per ounce, down $43 from yesterday's close, down $127 from last week's high. The financial headlines read, "Gold retreats from recent highs," and precious metals under pressure as dollar strengthens. The price is falling. The headlines say so. The futures market confirms it. Yet I cannot buy gold, at any price, from any major dealer, for immediate delivery. APMEX, waitlist. JM Bullion, temporarily out of stock. SD Bullion, pre-order only, estimated ship date 6 to 8 weeks. Kitco, limited availability, maximum 2 coins per customer. Money Metals Exchange, waitlist. Provident Metals, inventory depleted. 6 major dealers, combined inventory, functionally 0. For the most basic gold product that exists. The price is $2,847 and falling. The product is sold out everywhere. This is not a market functioning normally. This is a market that is fractured, split into 2 separate realities that cannot both be true. Either gold is available at $2,847 and the dealers are lying about inventory, or gold is genuinely unavailable and the $2,847 price is a fiction that describes nothing you can actually buy. The fracture that precious metals analysts have warned about for years, the divergence between paper gold and physical gold, stopped being theoretical this week. It became operational. It became a receipt showing unavailable next to a price quote showing available. The gold market just broke. And the break reveals something about our financial system that most people won't understand until it's far too late to act on. Here's what they're not telling you. The price you see quoted for gold, the $2,847 on financial websites, the number that scrolls across CNBC tickers, the benchmark that gold ETFs track, is not the price of gold. It's the price of gold futures contracts traded on the COMEX exchange. Futures contracts are agreements to buy or sell gold at a specified date in the future. They're paper instruments. They reference gold without being gold. When you trade a COMEX futures contract, you're not buying or selling metal. You're buying or selling a financial derivative that tracks metal prices. For decades, this distinction didn't matter. The futures price and the physical price moved together, kept aligned by arbitrage. If futures traded below physical, traders would buy futures and sell physical, profiting from the spread while compressing the gap. If futures traded above physical, the opposite trade would close the divergence. The arbitrage assumed that futures could convert to physical, that someone holding a paper contract could demand delivery and receive actual metal. The conversion mechanism kept paper honest. Paper couldn't diverge too far from physical because divergence created profit opportunity that traders would exploit. The conversion mechanism has broken. At 2:15 p.m. Eastern, on January 28th, COMEX published its daily delivery report. The report showed 287,000 contracts standing for physical delivery against registered inventory of 11.2 million ounces. The contracts represent demand for 28.7 million ounces. The inventory available to meet that demand, 11.2 million ounces. Delivery demand exceeds delivery capacity by 17.5 million ounces. At current prices, that's a $50 billion gap between what paper holders are demanding and what the exchange can provide. The gap doesn't show up in the futures price. The $2,847 quote assumes delivery will occur normally. But delivery cannot occur normally when 28.7 million ounces are demanded against 11.2 million available. The dealers showing sold out are not experiencing isolated inventory problems. They're experiencing the downstream effects of a delivery system that cannot function. The gold that should flow from COMEX through wholesale channels to retail dealers isn't flowing because the gold doesn't exist in sufficient quantity to honor the claims made against it. The fracture runs from the exchange level down to the retail level. The price that assumes delivery works becomes fiction when delivery fails. The fiction becomes visible when you try to actually buy what the fictional price supposedly represents. This is where the lie becomes unsustainable. The paper gold market and the physical gold market have separated into distinct systems that no longer reference each other. Paper gold trades at $2,847 and falling. Physical gold, when you can find it, trades at premiums that exceed anything in modern market history. At 9:30 a.m. Eastern on January 29th, a wholesale transaction cleared through LBMA settlement. 100 kilograms of gold bars, approximately 3,215 troy ounces, sold at $3,890 per ounce. The spot price at that moment showed $2,891. The premium, $999 per ounce, 35% above the benchmark, 35% premium. Not at a retail dealer adding markup for small quantities. At wholesale, between institutional counterparties trading 100 kilogram lots. The paper physical spread at the institutional level mirrors the retail level reality of empty dealer shelves. The arbitrage that should compress this spread isn't operating because the arbitrage requires physical gold to function. To arbitrage paper versus physical, you need to be able to buy paper, take delivery, and sell physical. But delivery is failing. The paper you buy cannot reliably convert to physical you can sell. The arbitrage opportunity exists only in theory. The spread that should be compressed is instead widening. Each day that delivery stress continues, the market learns that paper and physical are different things. Each day the premium for physical expands to reflect that difference. The price quote of $2,847 describes paper gold, contracts trading between parties who mostly never intend to take delivery. The sold-out notices at dealers describe physical gold, actual metal that people want to hold, that doesn't exist in quantities sufficient to meet demand. When paper and physical diverge this dramatically, the paper price becomes a fiction. Not a lie exactly. The contracts do trade at $2,847. But a fiction in the sense that the price describes something you cannot actually buy at that price. The quote and the reality have separated. The fracture was inevitable. Paper gold markets have operated at leverage ratios that made fracture mathematically certain once tested. COMEX trades 27 million ounces daily against registered inventory of 11.2 million ounces. LBMA clears even larger volumes against float estimated at 2,400 tons, perhaps 77 million ounces against daily trading volumes 10 times that amount. The leverage worked when conversion was rare. Most paper traders never wanted physical. They wanted price exposure, speculation, hedging. Financial objectives served perfectly well by paper that referenced gold without being gold. The small percentage who did want metal could be accommodated from inventory float, supplemented by ongoing mine production. The percentage wanting physical has changed. The delivery demand at COMEX, 287,000 contracts standing for metal, represents 23% of open interest. Historical norms run 3 to 5%. The shift from 4% to 23% overwhelms a system designed for minimal conversion. The shift reflects change psychology. The holders demanding delivery don't trust paper. They've watched LBMA settlement failures. They've watched Shanghai vault depletion. They've watched premiums widen from 3% to 35%. They conclude, reasonably, that paper claims may not be honored when the gap between claims and underlying becomes undeniable. Their demand for physical validates their concern about paper. The very act of demanding delivery stresses the system that couldn't survive mass demands. The system's failure confirms the wisdom of demanding before failure completed. When institutions do what they're doing now, they're not managing a temporary dislocation. They're watching a market structure collapse in real time. At 4:47 p.m. Eastern on January 28th, CME Group, COMEX's parent, issued an emergency notice. The notice announced implementation of position accountability protocols for gold futures, requiring traders with positions exceeding 6,000 contracts to justify their holdings to exchange officials. The notice also increased margin requirements by 25%, the third increase in 6 weeks. Position accountability and margin hikes are the exchange's tools for reducing open interest, for forcing traders out of positions before delivery demands exceed delivery capacity further. The tools are blunt. They affect all traders equally, punishing those who want metal alongside those who don't. The tools reveal the exchange's fear. COMEX is not calmly managing normal volatility. COMEX is scrambling to reduce delivery demand before the delivery failure becomes so large it cannot be managed. At 6:15 a.m. Eastern on January 29th, Before U.S. markets opened, the LBMA published an unusual statement. The statement acknowledged elevated settlement times and enhanced verification requirements for physical delivery requests. The statement assured market participants that delivery obligations will be honored within extended settlement frameworks. Extended settlement frameworks. The phrase is bureaucratic camouflage for, we can't deliver on time, but we'll deliver eventually. The assurance that obligations will be honored implicitly acknowledges concern that they might not be. The LBMA has never issued such a statement. In the London gold market's 300-year history, delivery was assumed. The need to assure participants that delivery will happen is itself evidence that delivery's reliability has become questionable. Less than 48 hours remain before the February COMEX expiration, the deadline when 287,000 contracts either receive metal or don't. The exchange is hiking margins, implementing accountability protocols, doing everything within its authority to reduce delivery demand before the deadline reveals whether delivery is possible. The countdown is to revelation. Either COMEX delivers 28.7 million ounces against 11.2 million available, a mathematical impossibility unless emergency supply materializes, or COMEX fails to deliver, offering cash settlement, forcing position closure, invoking force majeure provisions that confirm paper's divergence from physical. Either outcome reprices the relationship between paper and physical. Successful delivery, if somehow achieved, proves the system works and compresses premiums. Failed delivery, more likely given the math, proves the system doesn't work and explodes premiums further. The gold price falling, while gold is sold out everywhere, is the market's pricing of paper that can't convert to physical. The fall reflects selling by traders who hold paper and don't want metal, traders exiting a market they recognize as broken. The sold out reflects buying by people who want metal and can't get it, demand that paper markets don't capture because the demand is for physical, not financial exposure. While Western markets fracture, Eastern markets function. At 9 a.m. Shanghai time on January 29th, 8 p.m. Eastern the previous day, the Shanghai Gold Exchange published its daily settlement report. The report showed 47.3 tons of physical gold delivered against contracts, actual metal, moving from exchange vaults to buyer accounts, with no settlement delays or extended frameworks. 47.3 tons in a single day. Normal operations. While LBMA issues statements assuring participants delivery will eventually happen, the SGE delivers without needing assurance. The contrast is not accident. The SGE was designed for physical delivery. The exchange prohibits the leverage structures that COMEX and LBMA use. When you buy gold on the SGE, gold moves. The paper-physical distinction that fractures Western markets doesn't exist in the same form in Shanghai. The Shanghai premium over London, currently $67 per ounce at comparable grades, reflects the market's assessment of which system functions. The premium says, gold deliverable in Shanghai is more valuable than gold theoretically deliverable in London because Shanghai actually delivers. China's gold imports accelerated dramatically in January. Customs data shows 147 tons entering China through Hong Kong in the first 3 weeks of the month, a pace that projects to nearly 250 tons for January alone. The gold that Western markets can't deliver is instead flowing to markets that can. The geographic shift compounds the Western delivery stress. Each ton that flows to Shanghai is a ton unavailable to meet LBMA or COMEX obligations. The arbitrage that might normally flow metal from east to west, selling at Shanghai premiums, buying at London discounts, runs the opposite direction because Western discounts exist only in paper, not in deliverable metal. At 7 a.m. Moscow time on January 29th, 11 p.m. Eastern the previous day, the Russian Finance Ministry published its weekly gold acquisition report. Russia added 12.4 tons to sovereign reserves in the week ending January 24th. The purchases occurred through domestic producers and the Shanghai Exchange, not through London or New York, where Russian entities face sanctions. Russia's accumulation removes metal from global float while demonstrating that alternatives to Western market infrastructure function. The gold Russia acquires doesn't participate in LBMA or COMEX settlement. It enters sovereign reserves that don't re-enter market circulation. The BRICS gold-backed settlement mechanism accelerates in response to Western market dysfunction. The mechanism's value proposition, settlement that doesn't depend on delivery systems showing stress, gains credibility each day the stress continues. This is what a system looks like when it runs out of time. The paper gold structure accumulated over decades. The leverage expanded year after year. More claims written against similar physical backing, more trading volume against similar vault inventory. The expansion was invisible while confidence held. The confidence is cracking. The 287,000 delivery demands at COMEX. The LBMA statement about extended settlement. The dealer shelves showing sold out. Each data point confirms that claims exceed underlying assets by ratios that cannot be sustained when tested. The trap has no exit that preserves current market structure. If delivery proceeds normally, somehow sourcing 28.7 million ounces against 11.2 million available, trust in paper is restored, but the physical shortage becomes catastrophically worse. If delivery fails, as the math suggests it must, trust in paper collapses and premiums explode. The exchange cannot find 17.5 million ounces. Central banks won't sell. The gold has flowed east and isn't returning. The mining industry produces 100 million ounces annually, but annual production can't compress into a 48-hour delivery window. Force majeure, declaring that extraordinary circumstances prevent contract performance, may be the only option. Force majeure would allow cash settlement at paper prices for contracts the exchange cannot honor with metal. The option is legal under exchange rules. The option is also admission that paper gold and physical gold are different assets with different values. Cash settlement at $2,847 for contracts that would deliver metal worth $3,890 transfers $1,043 per ounce from contract holders to the exchange and its clearing members. On 287,000 contracts representing 28.7 million ounces, the transfer exceeds $29 billion. $29 billion that contract holders expected to receive as gold value, instead kept by the system that failed to deliver. The transfer, if it occurs, teaches a lesson that cannot be unlearned. Paper is not physical. Contracts are not metal. The price quoted on screens describes trading in instruments that may not convert to the assets they reference. Those who hold physical gold, metal in their possession or allocated storage, are learning a different lesson. Their holdings didn't become unavailable. Their inventory didn't show sold out. Their wealth exists independent of exchange delivery stress or settlement frameworks. The premiums that seemed expensive when physical was available look cheap against current availability. The 3 to 5% premiums of early 2025 are now 30 to 35% premiums, when you can find metal at all. The holders who paid premiums 12 months ago are holding assets that appreciated by the premium expansion plus the underlying price move. The question for everyone else is whether physical gold remains accessible at any premium before the delivery deadline reveals whether paper gold has any connection to physical reality. Reality asserts itself through sold-out notices that contradict falling prices. The fracture between paper and physical cannot persist indefinitely. Either paper prices rise to meet physical prices, requiring the short positions suppressing paper to capitulate, or physical becomes entirely unavailable at any price, requiring markets to acknowledge that gold has bifurcated into tradable paper and untradable metal. The all-time high that gold reached earlier this month, $3,470 on COMEX, achieved January 22nd, was a paper high. Physical gold never traded at $3,470. Physical gold at $3,470 would have required the premiums that already existed to compress to zero. Instead, the paper high occurred while physical premiums were widening, pushing the actual cost of physical gold above $4,100, even at the paper peak. The ATH broken headline describes paper retreating from paper levels. It doesn't describe physical, which has appreciated continuously as paper diverged. The physical all-time high isn't behind us. It's wherever physical sellers will accept payment, a level that rises each day inventory remains depleted. The market has fractured. The fracture is visible in dealer inventory, in settlement statements, in the $1,000 plus dollars gap between paper quotes and physical transactions. The fracture will not heal until either paper and physical reconverge, through paper rising to meet physical, or until the market acknowledges two separate assets trade under the same name. The reconvergence, when it comes, will be violent. The shorts suppressing paper prices face unlimited losses if delivery failure forces them to source physical at physical prices. The unwind of short positions that cannot covering would require metal that doesn't exist, produces price moves that technical analysis cannot capture because the moves are mechanical, not psychological. Sold out everywhere, yet falling on screens. The contradiction is the fracture. The fracture is the truth that the paper price has been lying about for years. The truth is that gold, physical gold, atoms you can hold, is scarcer than the paper markets acknowledged. The truth is that claims exceed underlying by ratios that cannot survive when holders demand delivery. The truth is that $2,847 describes nothing you can buy, while sold out describes everything you'd want to own. The fracture will resolve. The resolution will produce prices that seem impossible against current quotes, but obvious against current availability. Sold out everywhere, falling on screens. Both statements are true. Neither statement describes the same market. The separation is complete. The reconnection comes next. And the reconnection will not be gentle.